Hello, welcome to episode 41 of the Golden Question podcast. In today's episode, we are going to be asking and answering the question, is Brent Johnson's milkshake theory incorrect? So I'm going to be splitting this up into three separate points. First point is mainly talking about the theory in general and the investment strategies of the two. And second, diving into certain contradictions and some things that may not seem logical in his theory. And the opponent that I'm going to be placing against Brent Johnson would be Peter Schiff, although I don't agree 100% with Peter Schiff, of course, but I think they have pretty interesting dynamic between the two in terms of their viewpoints. So real quick, starting off point one, Brent Johnson believes that although the dollar will eventually collapse some point in the future, in the meantime, you want to still take advantage of the upswings in the market, in the US dollar, in the treasury, US stocks, and benefit while also somehow, and this is where it gets kind of confusing, while somehow still believing that in some point in the distant future, he doesn't think it's way out, but relatively 50 years, that the dollar will crash at some point. Now, Peter Schiff, on the other hand, doesn't have a time horizon, although I don't think he thinks it's that long. But he just believes, prepare now for when this dollar will collapse, because you don't want to time it because it's impossible to time it. So might as well make yourself prepared now. And I think that the second argument, the latter, by Peter Schiff, is the more sound and safer investment advice. We don't know when the dollar is going to collapse. And in fact, if you know something will inevitably happen, why not prepare for it? Why take the risk and gamble and try to time it and say, you know what, it's not going to happen in a couple of years, so let's just, keep investing in the opposite strategy, hoping to somehow make a return, and you might miss the timing. Right, the dollar may crash when you're holding all these U.S. treasuries and all these U.S. denominated assets, U.S. dollar denominated assets. So to me, that advice is not sound. Now, Brent Johnson actually brings this up and says, you know what, I manage people's money. Now, Peter Schiff also manages money, but indirectly he sort of runs the company, which is why I noticed it, because a lot of his earlier podcasts from years ago when I was listening, he would constantly give you that FDI, the FINRA disclosure at the end of every podcast. And, he was very wary in exact investment advice. He wouldn't do too much. Now he doesn't do any of the FINRA, and he's constantly giving investment advice, telling you to invest in these stocks without even doing these disclosures. And it's because he sort of backed away from being sort of this registered broker and letting other people in his company do it. So the first thing is, to me, what Brent Johnson said is that he has a fiduciary duty to make money for his clients. And that means he does have to make sure to take advantage of certain upswings in the market when they come, even though they may seem contradictory towards the long-term outlook. But what I think he fails to understand is you also have a fiduciary duty to not make unreasonably risky investments and to make sure your clients don't lose money. And for me, if you look at the responsibilities that you have as a client money manager, number one is to not make your clients lose money. Like, that is above making your clients money, because making your clients money induces considerable risk, while making investments just to retain your clients' wealth and have it not go down, or at least try to keep up with inflation, is much more of a larger portion of your fiduciary duty, in my opinion. So when he says, I have a fiduciary responsibility to make people money, someone should just bounce back. You also have a fiduciary duty not to make them lose money, or not make them, lose money. So a client will more or less sue you when you lose money rather than sue you for not making them enough money. So very rarely is a client going to say, you know what, the market's gone up 20%. I only made 5. I'm going to sue you. They're gonna sue you if they lose you money. If you lose the money, even if the market goes down. And that's the beauty of gold and silver and the precious metals and gold mining stocks, emerging markets, right, moving away from the dollar, is that it really, looking at the framework, there's very little downside. The only downside we have is this interim where people sort of still believe that, yeah, the Fed has a shot of rescuing things while not crashing the dollar. But I think the sentiment right now universally is that the Fed has a choice. They either keep interest rates low, and people are aware that the dollar is losing value, and so they're making their decisions accordingly, or the Fed raises interest rates to help save the dollar and cut down on inflation, but that'll send the entire market crashing down, right? We're immensely financialized, immensely indebted as a nation, both from the government standpoint and privately, right? Sorry, public and privately. And so that's going to, any society that's in debt, when you raise interest rates, you're forcing people to, you're increasing the financing cost of the debt, and you're forcing people to deleverage. And so that's going to send the entire market crashing down. So that's the beauty of having this portion of your portfolio invested in these precious metals, emerging markets, and stuff contrary to the dollar. And that is, there really is no significant downside, in my opinion. And so to say, you know what, I want to take advantage of these upswings, let me invest in some of the U.S. treasuries, let me invest in some U.S. dollar denominated assets, is just way too much risk. That I think in general, if you look at the type of clientele that believe in our philosophy, they're not willing to take that risk. I think Brent Johnson has it wrong there, and that is, it's safer to just prepare for the end now rather than try to time it, and you may miss the mark. So that's the first point that I disagree with. And I forgot to preface this earlier on, but I'd like to just say that Brent Johnson, I agree with actually a lot of what he says, believe it or not. I think he's one of the first people that, because I kind of came a little late, although I did see Brent Johnson talk about his Milkshake 3 years ago, but that's when I didn't really understand the global markets as much as I do now. I did read a lot of books in the recent years, and it really helped broaden my scope of economics and more or less looking at it globally, because I think that's something that Americans unfortunately face, is that we're very U.S. focused and we only look at how things relate in the U.S. market, but we're in a global economy. This is a point that Brent Johnson sort of brought me into and made me expand my scope, is that we are in an immensely global economy. Something in China, at one point I think he said, is that something in China in the real estate market can have a domino effect leading up all the way to here. That is how the banking system, the economics, the financial system is very intertwined globally. So you can no longer just look at the US market and try to make sound financial decisions. You need to look globally. You need to have a global zoomed out approach to your investment strategy and see, okay, am I taking the necessary risks? Am I factoring the necessary risks if something happens outside of the US? So no longer as if, you can't just ignore the rest of the world when you're making your financial decisions. So Brent Johnson helped expose me to that, and one major point he brought to my attention, which I never really factored in, is how much the rest of the world uses the dollar. And I think the figures he points out is that the rest of the world uses the dollar more than Americans themselves, right? That he calls it the euro dollar market, which is all these dollars used in transactions, used in trade, used in debt outside the world, is actually larger than the aggregate dollar market in the US. And so that shows you how global the dollar has become. And his main point, now let's transition to the second point that I want to address, and that is the fact that he believes that a decline in the demand in the dollar will inevitably lead to an increase in its demand. And this is where I think he falls into this loop, this loop argument, this contradictory loop. And that is, if the dollar is losing value from a foreign sentiment standpoint, that is the new equilibrium. And he had a interview with Robert, I believe it's Robert Murray. Let me look him up. Yep. Oh, no, not Robert Murray. Robert Murray. Oh, he's an mining engineer. So who is this guy from the Mises Institute? Robert. I'm going to look up the Mises Institute. Robert Murphy. Okay, so Robert Murphy, he did a beautiful podcast sort of interview on the Action Podcast with Robert Murphy. And he sort of tried to dissect a little bit of this. And I think Brent Johnson didn't do a good job of defending his position or trying to argue the contrary. And that is the new equilibrium. Again, I'm quoting Robert Murphy here. The new equilibrium is that the dollar's values decline. What Brent Johnson is saying is no, the equilibrium is, right, the fact that the dollar is losing value is not the equilibrium. And so when the dollar does lose value, it eventually will increase in value and in fact auto correct too much and the value of it will go above the new the desired equilibrium. And this is where I think the contradiction is, because when you say the dollar is losing value, that's it. The dollar is losing value, and people, interestingly, will benefit from moving away from the dollar as an economy as a whole. And if you look at the debt market, both from a borrower and a lender's point of view, they benefit, both of them. This is the beauty of this, the way the economics works here, is that both of them will benefit from leaving the dollar. Because if you think about it, if the dollar is losing value, by definition, less people are using it, which also means that there's less dollars floating around in that market. So from a lender's point of view, he doesn't want to get paid back in dollars because they don't have value. And this is why the demand of money is very interesting. And it sort of has similar certain similarities to demand of other commodities. And this is another thing that Brent Johnson brought up in that podcast with Robert Murphy, and that is money is kind of special. The demand and supply economics of money is different than of other commodities. I kind of disagree a little bit. I think that money, as Peter Schiff argues, is at the end of the day just the most marketable commodity. And so it shouldn't really have two big differences in the way that supply and demand works. But one thing is, just because supply goes down doesn't mean that demand has to go up. Supply can go down and demand can go down at the same time, right? If a product is becoming obsolete, its supply can go down, manufacturers will stop making that supply, but so will its demand. It's not like automatically when something goes out of fashion and the supply goes down, demand all of a sudden has to bounce back. And that's, I think, the flaw in Brent Johnson's theory, is that he's saying because the dollar is becoming less available, by definition, demand has to go up. So going back to the lenders and the borrower's point of view and how they both benefit from the dollar, sort of going out of fashion, going out of fad. The lender, of course, benefits because he doesn't want to get paid back in something that is declining in value. And the borrower, this is interesting, the borrower is also incentivized to paying back in something else than the dollar because it's not available. There's less quantity of it in the market, and it's harder for him to find those dollars to pay back. So they mutually benefit in this framework where the dollar is losing value. Now, this is true if the dollar is losing value sort of universally at an even level amongst all foreign investors. And I think this is the caveat that I have to make here with my counter argument, is that if there's one country that still values the dollar, it's going to soak up, they're going to soak up a little bit, and not soak up, that's the wrong analogy. They're going to bring up a little bit of that demand. And so if that country has a borrower, it's going to be easier for him to grab those dollars. He's going to want to pay back the lender and borrower, and he's not going to try to renegotiate the debt instrument or the debt contract. And if the lender's in that country where there's still this high demand of the dollar, they're not going to want to rechange or rewrite the debt contract. The lender's going to want to be paid back in that dollar. So this is the only caveat. But that's another small point that Brent Johnson, I think, fails to miss, is that, these debt contracts, these trade agreements, they could all be amended and changed and rewritten. It's not like once they agree and they are set on the dollar and the dollar loses value, then they have to stick by them. And the beauty of, because they mutually benefit from moving away from the dollar, I think all these debt instruments are going to be rewritten. Pay me back in gold, pay me back in my local currency, that we believe will appreciate against the dollar. So this is the second point that I wanted to address, and that is there's this circular loop logical problem with Brent Johnson's theory, and that is the equilibrium is that the dollar has declined in value. And so bringing it up, having it decline in value only to bring it up because it's losing value is kind of a nonsensical argument. You can't say that something will generate its own demand simply by its demand declining. So, thanks for listening. I know I just uploaded a video of me unboxing my first gold and silver coins. It was 1 gold eagle and 5 silver eagles. I did buy some Morgan silver dollars that I'll do an unboxing of, so stay tuned for that. And I think from now I'm going to try to collect, because I bought if you saw in the unboxing video, I bought a box holding 50 capsules for the silver dollars, and so I think now it's just only right for me to fill up the 50 first, and then once that's done, I think I'll buy some silver on that 1-to-5 ratio. But seeing that box empty, I just want to fill that box up with as many silver coins. And I looked at the dimensions for the silver dollar and the silver eagle, the Morgan silver dollar and the silver eagle. They're very similar, so we'll see if they fit in the same capsule. And then after I collect, I think, my 50, then I'll go continue that 1-to-5 purchase ratio, or even hold my silver altogether. But for the first time, the date is now July 11th. Silver is making a rally. Silver is going up. It's hitting, I think, a 10-year high right now. Gold, of course, has always gone up, but silver for the first time is actually making some moves. Now we'll see if this is a move to a new level, or if this is just going to get corrected down to its 30-year average. So that's the only problem right now with silver, in my opinion. I think a lot of people see it, and that is, it just hasn't done anything in the past 30 years. Yeah, it had a big spike up a little bit, like in 2011, a little bit when gold went up, but from that point on, it just flatlined, which in today's inflationary market is not good. Flatlining is, you might as well be going down rather than flatline, because in real terms you are going down. So silver, hopefully it moves up and starts making new resistance lines and keeps going up, but I just wanted to give you an update on that. So stay tuned for the next episode. Thanks for listening.